Hey everyone, welcome back to Corporate Decoder. Today, Antero Resources Corporation just filed their quarterly report for June 2026, and I am seeing some pretty big moves that tell a story. Quick note, this is not financial advice, just my take on public filings for educational purposes. After a massive acquisition and some strategic sales, Antero is reshaping its business, and the numbers are showing it. Let's dive straight into the financial tables. Looking at their balance sheet as of the 30th of June 2026, their total assets jumped to over $15 billion. That is a big leap from $13.2 billion at the end of 2025. A huge part of that is the HG acquisition we'll get to in a minute. On the flip side, liabilities also went up, largely due to new long-term debt. Their total liabilities are now over $6.9 billion, up from about $5.5 billion at the start of the year. Now here is where it gets interesting. Their equity, meaning what is left after subtracting liabilities from assets, grew significantly. Total equity is now over $8.3 billion, up from $7.7 billion. This growth is largely driven by retained earnings, meaning the company is holding on to more of its profits. When we look at their income statement for the 3 months ending the 30th of June 2026, their total revenue was a massive $1.56 billion. That is a solid jump from $1.3 billion in the same period last year. Natural gas sales were almost $689 million, while natural gas liquid sales brought in over $587 million. Oil sales also saw a nice bump. What is really driving that revenue increase is the HG acquisition, which added significant revenue streams from February 2026 onwards. This strong revenue translated into healthy profits. Net income attributable to Antero Resources Corporation for the 3 months was $278 million, leading to a diluted earnings per S-share of 90 cents. That is up from 50 cents per S-share in the same quarter of 2025. Looking at the first 6 months of the year, the story is even more impressive. Total revenue shot up to $3.5 billion, a big jump from $2.65 billion in the first half of 2025. And the profit, it is huge. Net income attributable to Antero Resources Corporation for the first 6 months of 2026 was over $813 million, leading to a diluted earnings per S-share of $2.62. That is a substantial increase from $1.16 per S-share in the same period of 2025. Let's talk about cash. For the first 6 months of 2026, the company generated a very strong $1.3 billion in cash from its operations. That is a big jump from $950 million in the same period of 2025. This shows the business is generating a lot of cash, which is always a good sign. However, when we look at investing activities, we see a massive outflow of cash. The company used over $2.6 billion in investing activities during the first 6 months of 2026. This is mainly due to the HG acquisition, where they spent a staggering $2.8 billion. This acquisition is clearly the dominant event impacting their financials right now. They also had proceeds from selling assets like their Utica Shale properties, which brought in over $756 million, helping to offset some of that spending. To fund all this, especially the HG acquisition, they also brought in a lot of cash through financing. For the first 6 months of 2026, they had over $1.1 billion in net cash from financing. This was largely from issuing new debt like the $1.5 billion term loan and $750 million in new notes. They also repaid a significant amount of debt, but the net effect was an inflow of cash. Now let's dig into some of the notes to understand what is going on. One of the biggest stories is the HG acquisition. On the 5th of December 2025, they agreed to buy HG Energy True Production Holdings, LLC for $2.8 billion in cash. This deal closed on the 3rd of February 2026, and it added a huge chunk of acreage in the Marcellus Shale. The company is still working out the final details of how this acquisition affects their assets and liabilities, which is pretty standard for a deal this size. On the other hand, they also sold off their Utica Shale properties. This deal, agreed upon in December 2025, closed in February 2026 for $800 million. This sale allowed them to pay down debt and focus more on their core assets. They recorded a gain on this sale, showing it was a profitable move. There is also a complex situation with Martica Holdings LLC. It seems a partner reached a certain return target, and as a result, Antero got back a significant portion of their interest. Then, on the 30th of June 2026, they dissolved Martica and distributed the assets. This means Martica is no longer consolidated in their financials. Simplifying things a bit. When we look at their debt, it is a mixed picture. They've been active in managing their debt. They issued new, longer term notes like the 5.4% senior notes due in 2036. They also redeemed older notes like their 8.375% senior notes due in 2026 and their 7.625% senior notes due in 2029. They also have a commercial paper program in place, which is a way to get short-term funding. As of the 30th of June 2026, they had about $182 million in outstanding commercial paper. Their credit facility and term loan are variable rate, meaning their interest costs will change with market rates. Antero uses a lot of derivative instruments to manage price risk. They have fixed price swaps, basis swaps, collars, and three-way collars. These are basically contracts to lock in prices for their future production. For the first 6 months of 2026, about 44% of their production was hedged with commodity derivatives, and another 15% with basis swaps. This shows they are actively trying to protect themselves from price swings. As of the 30th of June 2026, these derivative contracts were worth a net asset of over $228 million. Antero breaks down its business into three main parts: exploration and production, their investment in Antero midstream, and marketing. The exploration and production segment is where they drill and produce natural gas, NGLs, and oil. Their marketing segment is about selling excess transportation capacity and trading third-party products. And their investment in Antero Midstream provides midstream services. The HG acquisition clearly boosted the exploration and production segment, while the Utica sale reduced it. Looking at market trends, commodity prices are always a big deal for Antero. While natural gas prices were down in the first half of 2026 compared to 2025, NGLs and oil prices saw increases. This price volatility is a constant challenge, but their hedging strategies help cushion the impact. They're also feeling the effects of inflation, which is driving up operating and capital costs. This is a trend affecting many companies right now. Comparing the first 6 months of 2025 to 2026, it is clear the HG acquisition had a massive impact. Revenue jumped by over $850 million and operating income more than doubled. This really highlights the scale of that transaction. In terms of money, Antero has a good amount of cash flowing in from operations, over $1.3 billion in the first 6 months of 2026. They also have access to credit lines. They believe this will be enough to cover their needs for at least the next year. Their capital budget for 2026 is around $1.1 to $1.3 billion, mostly for drilling and completing new wells. Now, let's get to my take on all this. Antero Resources is clearly in a period of significant transformation. The HG acquisition is a huge bet, bringing in substantial revenue and production, but also adding a lot of debt. The company's ability to manage this debt and integrate the new assets effectively will be crucial. Their strong operational cash flow is a positive sign, and their active hedging strategy provides some stability in a volatile market. However, the sheer size of the acquisition and the associated debt mean there are significant risks involved. The biggest story here is how well they can execute on this new, larger scale. The Utica sale was smart, shedding a less profitable asset, but the HG deal is a game changer. What I'll be watching closely is how their debt levels evolve, and if they can continue to generate strong free cash flow to service the debt and fund their growth. The market seems to be reacting positively for now, with recent analyst ratings showing optimism. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.